right, guys, I want to actually state this. This is a part 1 video. So this is Warner Brothers Discovery part 1, so to speak. What I want to state is, because it is unfortunate, I'm going to be doing the official video because it won the vote for Discord, and I really wanted to do a well thought out video. So this doesn't count as the video. This is just part 1 for some preliminary thoughts. And in fact, if it engages the audience even better. So this is where you guys can comment down below and share your thoughts with the community about this company. So for you guys know that it's a small part of the portfolio right now. And now that the merger is done, we can kind of digest the new business. According to, for example, various analysts, the business is quite undervalued. We see Michael Burry buying this company or holding this company at the very least. We don't know if he actually still has it, but let's assume he does. What do we have here? What have we been given or bestowed upon by not Walt Disney, AT&T. So we have Warner Brothers Discovery with a plethora of content, right, coming from Discovery, coming from Warner Brothers. We have HBO Max, which is this new up-and-coming stream. We have Discovery Plus. Okay, so with that, what do we got? We have a company that is going to generate about $40-ish billion in revenue, over $40 billion in revenue, but has about $58 billion in debt, after the fact. And this was a question brought up in the Discord by one of the newer members, so I want to address this as well. The company acquired all this debt from AT&T. So upon the spinoff, AT&T was like, "Hey, Discovery, you want this company? Well, this new company will incur this, I think it was $43 billion in debt." So that coupled with Discovery's debt, and I'll actually show this to you guys here because technically websites are not up to date. So if you go on any free website, let's go on like Yahoo Finance. And I'll showcase what I mean for you guys. All right, so if you take a look at the line item, this is Warner Brothers Discovery, by the way. If you don't believe me, there it is. Okay, so if you go down to the line item of total debt, you can see that the total debt stands at about $14.7 billion. Well, this is incorrect because the numbers are not up to date. This is why I'm doing this kind of apology video about not being able to do the video on time. But rest assured, because it did win the vote, it will get its video for sure, 100%, when all the information is out there, when the company reports everything all together. I will be sure to do a video. Now, before we get there, I'm going to be kind of discussing the risk associated because I think we can still kind of discuss that. So the company together is going to generate close to $23-ish billion in free cash flow, okay, after everything. And then what the company plans on doing is spending about $20 billion this year alone in content spend. Remember the numbers from Netflix when we analyzed Netflix, which again, you guys can check out in the content library. It will be there. So Netflix spends about $17 billion a year in content. We know Disney spends about $33 billion a year in content. We know Amazon's spending as well, Apple spending as well. So this $20 billion figure, it's a hefty amount, but the company supposedly can afford it. This leaves about $3 billion, or give or take a little bit, maybe a billion, maybe a couple billion, in about the ability to pay down that debt, right? The company is looking to reduce that leverage to about 2 to 3 times EBITDA, right? EBITDA stands for earnings for interest, taxes, amortization, depreciation. So that's the cash or the money made by the business before those interest obligations, then you pay the interest. So we use EBITDA actually to gauge whether or not a company can pay for some debt. That actually makes sense, not to use necessarily net income. Net income takes into account after those interest expenses. So we use EBITDA to kind of make sure that they can pay for those interest expenses. Does that make sense? If that makes sense, we're good. If it doesn't make sense, feel free to ask down in the comments below. Okay, so from there, we kind of see, okay, we know that they can probably afford this debt, right? They can afford to sustain this debt. They have an ambitious roadmap to spend a lot on content and pay down the debt because they want to reduce that leverage. Okay, all well and good. Now, my concern comes from, well, we look at the balance sheet of Disney. Well, Disney's not really in that good of a shape either. They got absolutely wrecked by the pandemic. And if you take a look at the content library, you can see all the older videos I made on Disney and how that's kind of evolved over time. In the past, we were talking bad about Disney when Disney was close to $200 a share. Okay, that's when people were bullish on Disney. But I wasn't too bullish on Disney at that time. And now that the price is lower, I'm still kind of on Disney. I'm not loving Disney, believe it or not. I think that Disney has a lot of question marks. Now, the price has come down even further, and I probably should do an update because maybe now the price is nice, but I think that Disney's problems are similar to Warner Bros. Discovery in the fact that we have a lot of debt here, and that presents a risk. So this is not a risk-free investment by any stretch of the imagination. And in fact, it makes me kind of uneasy a little bit. So I look at Netflix and I see Netflix is better capitalized to spend on content than something like Warner Bros. Discovery. Sure, they don't have the content library. Absolutely true. They don't have, DC. They don't have, Harry Potter. They don't have all of these other things or franchises that Warner Brothers owns. They don't have that. Fine. They don't have Game of Thrones as well. But really, like, what do we have to consider here? Well, I think that Netflix, for example, they have Netflix, Amazon, Apple, for that matter, any one of these other companies that really wants to spend on content, the big boys, the FANG stocks, they have tons of cash, right? They have the ability to spend, and they have the balance sheets which gives them the ability to borrow should the need arise. Okay. I think that, for example, and I've been very clear about this in the Netflix video, I think there's room for a couple winners at the very least. I think that every household will have 2 to 3 streaming platforms. I know that's ambitious, but when I looked at the data regarding to the past spending, so I call this the spending appetite for a consumer on entertainment. When I take all this into consideration, I think that there is room for 2 to 3, and the consumer will still spend less on an adjusted for inflation basis versus past Americans, at least in the United States. Now, we talk about the rest of the world. Well, that's a different story. There's more room to expand as the world kind of becomes wealthier. Of course, these companies can kind of expand in that direction. Right now, HBO Max is trying to focus on conquering the United States, the Americas, etc., trying to grow in that front, and as well as in Europe. So that's HBO Max's current goal. Asia can come later, but of course, I think they're trying to get Asia as well. Now, one thing that they have going for them is they have what I call a recapture event. Okay, a recapture event, and you heard this here first, folks. A recapture event is what I'm calling the time where they go to the box office. So when Warner Bros. Discovery produces a movie, they take it to the box office, they sell the tickets, they hopefully break even at the very least, and maybe even eke out a profit. Netflix does no such thing. Netflix produces a movie, and this is a weakness of Netflix that I discussed in my Netflix videos. Netflix produces a movie, they put it on their platform, and they assume a retroactive value, or not a retroactive value, sorry, a future value on that movie regarding their content and subscriptions. Okay, they make an assumptions. The management makes some quote unquote reasonable assumptions on the value of that movie going forward into the future. Okay, now Warner Bros. Discovery makes that movie, puts it into the theaters, makes its money back, maybe makes a profit, then puts it onto its streaming platform. This is what I call a recapture event. So the risk profile is less than something like Netflix. If Netflix makes a bombshell, right, just a terrible movie, they just basically burn money. Now, if Warner Bros. Discovery makes a quote-unquote bad movie of the same cost structure, they might make some of the money back. Maybe at the worst case, they lose some money, right, but not all the money. And maybe they break even on a medium case, and then maybe they just make barely a profit on kind of like a case. So I think this should not be underestimated. I think that is a big advantage. I think Netflix actually should take a lesson out of this and try to maybe expand into theaters. I know it sounds crazy, but yeah, get into theaters, Netflix. Just do it. And then for movies. Your TV show's fantastic. Keep it like that. I think TV shows should stay as they are, and movies should go to the big box office first and then transition over rather quickly. Okay, I'd say after about a couple months, it should go straight to the streaming platform, okay? On that, well, they have to actually plan it out, so it overcomplicates it, but they have to plan it out in such a way that it's not so quick that no one's going to go to the theater because they can just watch it at home. You got to give the incentive to go to the theater, and so you can allow that recapture event to occur. Okay, so with that being said, what do I want to say about this? Well, the companies in the portfolio, am I adding to it? I'm kind of on the fence here, guys, and I want to hear your thoughts. I'm really on the fence here, and I've been going back and forth on it. Those of you who I've been talking to on the Discord will know, yes, I'm on the fence about it, and you guys know who you are. I think that this company I think it's a good company. I think it's got good content. I think so. I do think so. I think it has potential, but it's not without risk. I think the risk is there. It should be this should not be considered a risk-free investment. It's not easy money. There is a problem here. If they miss on any execution, this could be bad. Okay, so any malinvestment that occurs within the company's operations could be detrimental to the company at large. Okay, I'll just say that. And I mean, that sounds obvious, but yes, okay. There's no other way to put it. So when the numbers come out, I will be doing a longer video. So consider this a appetizer for that video, and then watch out for when the numbers kind of come out together, how I kind of talk about it and report on that. All right. On that note, guys, thank you guys so much for watching, and I'll see you guys in the next one. Bye.